If I asked you who the most famous investor of all time is, most people would say Warren Buffett. But in 2020, we had a new rock star that entered the arena. It was Cathie Wood, who had made some very bold claims about stuff like Bitcoin and Tesla in the past couple years. And then things went really well for her, and she became a household name making predictions about the stock market overall. In 2020, her ARK ETF was up 130%, and people thought this trend may continue as the stay-at-home stocks and the momentum stocks were taking over the overall market, and she seemed poised to be the passing of the torch from Warren Buffett on to Cathie Wood. But as the stock market has fallen in the past year and a half, she's taken a fall out of grace, and you'll see stuff about Cathie Wood as being a scam. I wanted to talk about the story of Cathie Wood and what we can learn about it as a normal investor. It's a story of someone who became a household name because of these risky investments, and as a result has taken a huge dip as the market has sold off in 2021 and into 2022. So I'll quickly go over who Cathie Wood is, because for people who don't know, she's been involved with hedge funds since 1998, and then she broke off to start her own fund, which is the ARK Innovation Fund, or ARK-K. This is a publicly traded ETF that you can buy, that you can go on their website and see exactly what their holdings are. So this was founded in 2014, and since then she's founded 5 other ETFs, which have a variety of topics like genomics, space exploration, and fintech. So you have pretty much all of the opportunities that you could possibly want when it comes to these ridiculously risky but potentially huge payoff for these growth stocks. Here's a clip of her on CNBC talking about her price targets for Tesla in the next 5 years.
Yes, the base case, it's a 5-year target, so the end of 24, it's $7,000.
And then here she is talking about her $1 million price target for Bitcoin.
Is it $1 million per coin by 2030? That still feels good to you?
Yes.
So for the longest time, Tesla was not this highly thought of stock. If you've been around the stock market for a couple years, you'll remember that it was having a really tough time in the late 2010s, and Cathie Wood was the loudest bull out there, and she would go on these shows like CNBC and Squawk Box talking about how she was incredibly bullish on the company overall. So when things started going incredibly well for Tesla in 2019 and 2020, she was one of these household names that people would throw on the thumbnails as being, she was right, she is the next coming of the best investor ever, and since then that has not gone her way. In 2022, her innovation fund, ARK-K, is down 70%, and considering that she's been a bull for Tesla, Tesla has also not done very well. So what can we learn from these ARK innovation funds? I don't want to just sit here and dunk on this woman who has done incredibly well in the investing field, but I want to talk about some things that we can learn from, because it does no good for us to just talk about the mistakes that she's made if we can't translate it into our own investing strategy. And the biggest one has to do with risk management. One of my favorite things about the ARK funds is that you can go on their website and see exactly what percentage of their holdings are in various stocks. And when you look at it right now, there's a nice mix of innovation funds out there. You see stuff like Docu, you see stuff like Tesla, and it's a nice mix between these major stocks. But we can use this website called the Wayback Machine that shows how this website looked back in February of 2022, and you can see the difference in the value of their Tesla position back in February when Tesla was still relatively high. And at this point, it was the largest holding by a pretty significant margin. And I think this is something that we can learn from, is that we don't want to fall in love with one stock and have it be the largest holding in our portfolio by a significant margin, because if things go well, yes, you're going to do incredibly well, but we've seen this as the favor of Tesla has fallen away. That is now the reason why the ARK funds are down significantly in 2022. Part of the dive from Tesla comes from the continual sell-off as a result of Elon deciding to buy Twitter. It has put him in the forefront of the news, and people are arguing that now that he's more focused on Twitter, he's not going to be as involved with Tesla, which at this point he's not as involved as he once was, but they see him as being the face of the company, and as he's forced to liquidate shares to pay for his $40+ billion acquisition of Twitter, it is not a good look for the company overall. Even though he does have only sold like 5% of his total holdings, it is not a good look to see insider selling in a time where you want your CEO and the face of your company to be like, yeah, I see us doing well in the upcoming years. So that has resulted in the stock price falling significantly in the past year. And here comes the risk management part of these funds. When everything is going well, having an innovation fund sounds fantastic. These are stocks that are going to do incredibly well in the upcoming future, in theory, if you're picking the winners. The problem is when things are not going well financially, these are the stocks that are going to get hit the hardest. These innovation funds are innovation for a reason. They are looking towards the future. And when we're looking towards the future with stuff like inflation and PE ratios for companies that don't actually have earnings, it makes them look really tough. And as a result, they've sold off significantly in 2022 as this bubble has finally burst. We've talked about the tech stocks popping in the 2000s as these valuations were getting ridiculous. And that's why I decided to jump into dividend stocks at the beginning of this year, because I thought there's no way this can continue. And if you want to see that video, I'll link that above right now, talking about why I decided to make the switch to dividend stocks. But Cathie Wood has doubled down and is kind of forced to double down based off of the construction of these funds. They are fully focused on innovation. And as a result, she can't buy these blue chip stocks that you would love to buy at a discount. She's kind of forced to buy these stocks that are going to be really hindered by the overall market conditions, and they're not going to be able to take off to the extent that they were in 2020. In my portfolio, I do have some risky positions. I have stuff like the solar ETF TAN, and I have stuff like PayPal. These are companies that I feel like are going to do incredibly well in the next 5, 10, 15 years, and that's why they're mostly sitting in my retirement account, something where I'm not worried about the day-to-day movements of it. Cathie Wood's in a position where she is investing other people's money, and it's a tough situation where I can happily sit by and have my 1% PayPal position go down 40% because I don't feel the need to buy right now on the dip. I have plenty of other options in stocks that I'm more interested in buying right now. Stuff like a Microsoft, Apple, PepsiCo, AbbVie, stuff that I love at pretty much any price, and I don't feel the need to catch the falling knife when it comes to a stock like Tesla, Docu, pretty much any of these innovation fund stocks, because I don't think this is the time to make the switch into the innovation stocks. And that goes along with my Bitcoin position too. For the longest time, it was too large of a position because Bitcoin's price has gone up significantly to the point where it was like 50% of my investments were sitting in stocks and 50% was sitting in Bitcoin. I've since been able to move the amount of funds to have it be where it's 75% stocks and 25% Bitcoin, but that's a huge risk because my bet is that it's going to reach $100,000 before it reaches zero. But there's still the chance that it reaches zero, and I don't want it to blow up my portfolio. And that's the whole reason why it's not 100% of my portfolio. And that's why you want to avoid keeping all of your eggs in one basket. So the next lesson that we can learn from Cathie has to do with rebalancing the portfolio. And this is kind of what I mentioned with the innovation stocks kind of being a potential hindrance for her overall. She has built this portfolio and these 6 different innovation ETFs as this way of investing into the future. But when stocks are going down in the short term and you're trying to look for future valuation, these are not the stocks that are going to have investors running to them looking for a safe haven. These are stocks that are really dependent on market conditions overall, especially when it comes to interest rates and the amount of money that it's going to cost to get their products off the ground to where they can be sustainable for the long term. A lot of these companies are taking on extensive amounts of debt to be able to pay for hopeful future innovations. And so in a time like this when inflation is really high, interest rates are on their way up, it's not as attractive to be buying into these stocks. And that's why I think it's important every year or so to go through and try to rebalance your portfolio. It's the idea of looking at market conditions and see if you want to change your strategy. If you're using the same strategy that you're using back in 2018, when a lot of these tech stocks were reaching crazy valuations, that's not the way to be investing right now. We've seen the switch towards these safe haven stocks, these dividend kings, the recession-proof stocks. You kind of have to look at the market every couple of months or every year and kind of see what do I want to do differently to try to protect myself for not only the short term, but the long term. We're trying to avoid having these positions that are down significantly because the farther down your portfolio goes, the higher returns it's going to take to get back to where you were. I'll throw up this graphic right now, which I think is the most damning way of investing, is that you want to try to avoid blowing up your portfolio at all costs. You see an initial loss of 8%, it's going to take 8.7% to recover. 25% down, it's going to take 33%. And you get up to 50%, you're going to have to double your position to get back to break even. And so that's why these dividend stocks are so attractive. They are not going to be the high-flying stocks that are going to double in 1 year. I'm never going to have the ARK-K returns of 2020 where it's up 130%. But it's the idea that I'm down not as bad as the overall market, so it's going to take a lot less movement to get back to break even. The market's down like 22% so far on this year. My portfolio is down 6% because I've been consistently adding to my losing stocks because they are blue chip stocks that I feel incredibly confident for the long term. If you're buying these stocks that are down significantly because people are worried about their long-term valuation, it's going to take a huge recovery to get back to the point where you break even. And that's the whole idea of avoid digging a massive hole. The market's going to fall. It's going to pull everything down. That's kind of what we're seeing. I have some stocks like PepsiCo and AbbVie that are actually green on the year, but for the most part, things are down, but they're not as down as some of these stocks that are going to be seen in these innovation funds. I think it's important to look back at the dot-com bubble of the 2000s because, yes, you have some of these stocks like Apple and Microsoft, they're able to survive those really tough times, but there are also plenty of stocks that you've never heard of because they went bankrupt. They didn't survive through a time like this. Am I saying that these stocks are going to go bankrupt? No, I'm not saying that. But I'm saying that there are stocks that are going to take years and years, maybe even a decade to recover. And we're trying to avoid that at all costs. We're trying to buy stocks that are going to be able to build wealth instead of a bag holding situation where you're kind of just stuck in this position waiting for it to get back to break even. We want to buy stocks that are going to be consistent in their gains, and that's why I have these steps set up for why I buy specific stocks and why I avoid companies that are going to go down significantly. Yes, you can have risk in your portfolio, but I don't think it's worth the potential catastrophic implications of having these stocks that are down 50, 60% and having them be a large portion of your portfolio. And in Cathie Wood's case, Tesla has been the thing that brought her to relevance when it came to her ARK funds, and unfortunately it's a thing that is dragging her down right now. So let me know what you think about involving risk in your portfolio and what's the riskiest stock that you own right now. And I'm just curious what percentage it is of your overall investing portfolio. For me, it's PayPal. PayPal is a company that I really believe in for the long term, but it's only like 1 or 2% of my overall portfolio, so I don't lose sleep over how bad it's down. I think it's down like 40%. I'm not worried about that at all. There will be a time and place where I decide to start buying that again, but right now all of my funds and efforts are going into these recession-proof stocks and these dividend kings that are continue to do very well and not go down as far, and also pay dividends that will allow me to dollar cost average on a reliable basis. So thanks for watching this video. If you made it this far, I'd really appreciate it. Hit that like and subscribe button, as it would help my channel out a lot. If you want to see future videos from me, be sure to hit that subscribe button. That'll be on screen. And then on the other side, I think I maybe got it right this time, will be a previous video if you want to see more content for me. My name's Andy from Magoo Investing. Thanks for watching. I'll see you in the next video.